You can convert the 20-year term before it expires, and you can convert the 30-year before it expires. So you're locking in the same amount of coverage for the long term, but you're saving right off the bat. You're saving about $100 a month, and then as those policies fall off, you save more and more. And so the savings, the total savings that you're saving here is $46,000 by utilizing this ladder strategy, right? And so this is what we do for clients, guys. Hey guys, Michael Garcia here, IC Life. Welcome back to the channel. What I want to talk about today is saving you a ton of money on your term life insurance. Right? We utilize, well, we can do that a couple of ways, right? Number one, you saw my video on making sure you get a underwritten product versus a simplified issue. That's going to save you a ton of money right there. But today, I'm going to dive into a specific strategy, a laddering strategy, where we actually ladder your coverage so you're not paying the full price as if you had the coverage for the whole time, right? Because sometimes you might want coverage for very specific things, but you don't necessarily want it for 30 years. And so what I see often is an agent might find out, hey, this is how much coverage you need. And then they're going to offer it to you for 30 years. But the reality is you don't need all the coverage or want all the coverage for 30 years, but you end up paying that price of having it for 30 years. And so what we do, if you've ever worked with me, I'm going to ask you a ton of questions, right? So I want to know not only how much coverage we want, how much we're looking for, but I'm going to ask timeframes as well, right? I'm going to ask, okay, you have kids, you want to make sure that there's money there for college if something happens to you. Well, how old are they, right? Because if they're already 14, 15, 16 years old or older, we might just be looking at 10 years of term coverage, which is going to be significantly cheaper because you're paying only for your ages 40 to 50. If you're a 40-year-old male, I'm going to use an example of a 40-year-old male in a minute. So you're only paying up to age 50. So the charges are going to be significantly less than if you were paying a 30-year up until age 70, right? Because it's more, the older you get, the more expensive it is to cover you. And so if your kids are that age already, you might be looking at a 10-year term. If you tell me, oh, I want to make sure our kids are 2 and 4 and we're planning on having another one, well, now we might be looking at 25, maybe 30-year, a 30-year term policy for that, right? And so timeframes are very, very important is what I'm trying to get across. Same thing if you're covering income, maybe you're, again, 40-year-old male, maybe you want planning on retiring at 65. So ideally you're thinking, okay, I need to cover 25 years of income. Well, that's great today, but 10 years down the road, now you're 50. Now you only need to cover 15 years of income, not necessarily 25. So it would be safe to say we don't need as much coverage at that point, and you may not want to pay for that much coverage because we can be more efficient with that money. We start looking at our permanent coverages, our retirement portfolio, all these other things that we can be efficient with our money. And so when it comes to term, you want to be very efficient. You want to have your cost, I think, as low as possible, right? Because there's no other benefits, there's no cash value when it comes to term. It's just the coverage. Now, doesn't mean it's just a death benefit. When I say no other benefits, you can still have your living benefits, right? Critical illness, chronic illness, terminal illness. And so we can still have some other benefits on this policy. However, what I'm going to show you right now is what I would do for, say, a 40-year-old male, laddering his coverage, and you're going to see just how much money that this client would save, right? And this is huge because now we can take that money and put it back into this client's future. So let me go ahead and share my screen. Okay, so here is a 40-year-old male. And what I did here was, again, I'm going to find out what is it that we want to cover, right? And so this is just a mock example. So this is an example of a client saying, hey, I want to cover. I have some debt, outstanding debt. Maybe it's some student loans. Maybe it could even be IRS debt. Who knows, right? There's all kinds of different kinds of debt, but could be vehicles, could be just liabilities that he has, right? So I want to cover $50,000. I need that paid off if something happens to me. Okay, great. When do we think that will be paid off? He might say 5 years. He might say 10 years, right? So we might not need this. Let's say he says 5 years. So we need to cover this for the short term, not necessarily long term, right? And so for income, he makes $100,000 a year and say we want to cover anywhere from 5 to 10 years of that income. Um, we might want to cover even more. It just depends. We obviously try to stay in a budget too. We always want to factor in what other coverages we have as well. So let's just say, for example, that 5 to 10 years is going to be 500,000 up to $1 million of coverage. We also want to make sure that we pay the mortgage off so our family doesn't have to worry about that, right? He's got a wife and 3 kids, so he wants to pay this $500,000 mortgage off as well, should something happen. And then education, let's say 450,000. So 3 kids, 150,000 each. And then here we have the ages 14, 16, and 17. So what does that tell us? It tells us, 10 years from now, the youngest is going to be 24. So we might not need as much coverage after that because the kids are going to be grown. They're going to be hopefully out of college, right? Hopefully self-sufficient. And so as a parent, we want to cover, we want them to become self-sufficient, but we still want to be there to make sure they have that good start, right? And we can do that a number of ways, not just through here, but through whole life coverage as well. So that would be another discussion. But as far as just covering the education and the costs, we want to throw it here on this term. And so if we add this up over here, our client is looking anywhere from 1.5 million all the way up to 2 million if they want to cover, say, that $1 million of income. And so that would give the kids the education, that would pay off the debt, it would pay off the mortgage, and then it would leave an additional $1 million for this family. And so that 2 million, we our client definitely wants this. Now, again, do we need to necessarily have a 30-year term, right, for that 2 million? And if we look at the mortgage, I'm going to ask, well, how many years left on the mortgage? Maybe he does say 30 years. And we know in 20 years, this mortgage will be a little bit more than half paid off, right? So there'll only be 250 in 20 years. Same thing with income. 20 years from now, he plans on retiring at 65. That means he's gone. He's made all that money for his family. And now he only has 5 years, maybe 5 working years left, right? He doesn't necessarily need to cover a ton more, especially if he has a solid plan. He's saving money for retirement. Now, he may want to have a lot more coverage, especially in whole life insurance. But when it comes to term, we're really trying to get the most coverage for the smallest cost here. And then we can use the whole life insurance. We can use other products to strengthen his financial status, right? So let's say we had that $1 million, that's 10 years of working years, but at 60, well, now he only has 5 years left. So at most, he might only need 500,000, and if he, took half that, 250. So let's say in 20 years, we don't need to cover the debt. We don't need to cover the education. And then we only need to cover, say, half of the 500 and half of the 500 years, which is a total of 500. So in those last 10 years, he might only need $500,000 of coverage. So what I want to do is compare a 30-year term policy with the laddering strategy, just so you can see how much money can potentially be saved and put back into this client's future, put into other products, other assets, some places where we can grow this money, right? And so let's go ahead and pull up this illustration. So this is a 30-year term with AIG. Now, this product has living benefits, right? It has the critical illness rider, it has the chronic illness rider, it has the terminal illness rider, and it's convertible up until the end of the contract or age 70. So now this product, you see it's a 30-year term up here on the top, QOL Flex 30. And then if we go to the death benefit amount, we can see that's $2 million right here. And our premium is $222.42, right? So that's a monthly premium. That is going to be a level premium, you can see, for 30 years. So you can see, multiply that by 12. That's how you get this annual premium of $2,669.04. And you can see that is not going to increase until we get to year 31. And at that point, things change, right? But this is locked in for those 30 years at $222. And so that is the 30-year term for $2 million. And now what I want to show you is the laddering strategy where we can layer coverages. And so in this case, we have the same total coverage, $2 million at the beginning, but what happens is we did it over 3 policies. So you can see right here, we have a $500,000 term policy, 30-year term, and that's going to cost $60.86, right? And then we have over here, we have a 20-year term, 500,000. So that's going to give us $1 million up until year 20, $38.41, right? And then over here, we have a 10-year term. It's $1 million. Again, we needed extra coverage early on because the kids, because of that debt, and that's going to cost $43. So if you add all that together, we're looking at 100. By the way, you can see there's a discount on each because you're getting a multi-policy discount. So it's going to come out down here if you see the $128.04, right? And so if we go back to our drawing board, we have one example where we have the 30-year term. And it's a level $222 per month. So if you were to multiply that by 12 months and then multiply it by 30 years, so let's say by 30 years, our total premium that we would have paid into this is $80,071.20, right? Now, with the laddering strategy, we'll do 30-year. I'll just put ladder. For the first 10 years, we are now paying only $128.04 per month. So that's for the first 10. So that total cost of premium is $15,364.80 over those 10 years. Our second 10 years, remember that the first policy is going to drop off. It's only a 10-year policy. So we're going to be left with the other two. And we're going to be paying $91.11 per month. And over that 10-year period, it's going to cost $10,933. And then the last 10 years, third 10, we're going to be left with that $500,000 policy that we are paying $60.86 per month, which comes out to $7,320. So if we add this all up using the laddering strategy, we're paying $33,601.20, right? So we compare this 30-year and this 30-year, right? Our savings is $46,000. $470, right? So it makes a huge, huge difference. And the question now becomes, what can you do with that $46,000, right? Is that something we want to put into a whole life? Is that something we want to make sure is liquid and we have access to it, right? Is that something that we want to be able to invest? Because remember, we can still layer whole life into this. In fact, I do that with a lot of clients. I'll actually use, instead of using the 30-year term, we'll only use up to 20 years, and then the rest will be permanent coverage. And remember, you can convert each of these policies as well, right? You can convert that 10-year term before it expires. You can convert the 20-year term before it expires, and you can convert the 30-year before it expires. So you're locking in the same amount of coverage for the long term, but you're saving right off the bat. You're saving about $100 a month, and then as those policies fall off, you save more and more. And so the savings, the total savings that you're saving here is $46,000 by utilizing this ladder strategy, right? And so this is what we do for clients, guys. This is why, like I said, if you work with me, I'm always asking a bunch of questions. I want to know timeframes. I want to know when you plan on retiring. I want to know where your kids are at, like what age, what the plans are. And it's not because I'm just trying to be nosy. I'm trying to give you the best service. And so in order for me to do that, I need to know exactly what it is you're looking for. And then that allows me to work on a plan that is as efficient as possible. So we are taking care of the coverages that we need and we want at the best price, best cost point. But then we're also being efficient so we can have money left over and we can work on our future as well, right? Because ultimately, I want to see you guys succeed. I want to see you buy that home. I want to see you retire in abundance. And in order for me to do that, I need to be as efficient as I can. And you might look at me and be like, "Hey, don't you make money when you sell more coverage?" Yes, I do. But ultimately, it's not what it's about, right? It's about doing right for the client and then just succeeding together, right? Having more that goes into the future. I never look at things as a one-time sale. It's always about how can I put you in the best position, get you what you're looking for, but at the same time, put you in position to have more access to capital, to grow your money, to grow your portfolio. And so this is one of the strategies we implement. And I hope, if you're looking at your term coverage, if maybe you have this big 30-year term coverage, nothing wrong with that at all. But if you're looking at the premium and you're thinking, you know what, maybe I could save a little bit of money, or maybe I want something a little bit more customized, a little bit more detailed, check us out. So there you have it, guys. Just using that laddering strategy is huge. It could save you a ton of money. It could put you in a position where now you have, again, more access to capital. I cannot tell you how important that is. I cannot. It's so hard to explain. I've seen people get overcommitted with certain policies, and I want you to be in a position where you have control and liquidity of your money, because ultimately, yes, it's about making sure you have the coverage, making sure your family's okay. We definitely want to do that, but at the same time, I don't want to oversell you when I can put you in a position where you can have more access to capital, have more money at hand, so that way you can build for your future, right? You can build your portfolio. You can start to, convert some of those policies into permanent policies with cash value you have access to. You can start to build a retirement portfolio. You can buy that house, right? Whatever it is that is your goal, that's what we want to do, right? That's what we want to help you achieve. And so by taking the insurance part of the picture and being as efficient as possible with it, it just gives us more money to help you achieve those goals, right? And again, you can ladder in a permanent coverage into that too, right? And not only that, but those policies are convertible. And so we can convert those as we go, as we build our portfolio, as we gain more wealth. Ultimately, what we want to do is just save you as much money as possible. So that way we have the best chance going forward, right? And so that's what we're all about. Just giving you back control of your money and putting you in the right position. And so anyways, guys, I hope you thought this video was informative. I hope it gave you maybe a new perspective and maybe even gave you some ideas of how you can structure your portfolio and your insurance portfolio, your coverages, and If you have any questions, of course, feel free to book a call. I'll leave the link down in the description. Go ahead and book a call, book a discovery call, reach out. You can always email me if you want me to review any of your policies. Maybe you have a big term policy and you're saying, hey, is there any way we can save money on this? You can email me. I'll leave that email down below, michaelanthony@iclife.net. So feel free to do that. And until next time, guys, I hope you guys got a lot of value out of this. Please like and subscribe for more content. See you next time.